Hello, and welcome to Wall Street Training's module on corporate valuation methodologies. My name is Hamilton Lin, president and founder of Wall Street Training, and I have a background in investment banking and mergers and acquisitions, having worked at Goldman Sachs' investment banking research, Bank of America Securities' mergers and acquisitions group, and several other boutique investment banks, all focused on mergers and acquisitions. Please note that these materials are copyrighted and may not be disseminated or reproduced without express written approval from Wall Street Training. Wall Street Training is a corporate training firm focused on teaching the concepts of financial modeling and valuation. We also hold a fair amount of public open enrollment seminars as well as self-study video-based learning. The range of our topics range from the basic and fundamental courses of accounting, how to analyze a 10K, to corporate valuation, as well as the basic financial modeling concepts, including the advanced financial modeling and valuation, as well as complex merger and acquisitions, as well as complex leverage buyouts. Again, my name is Hamilton Lin, and I will be your host throughout the duration of this particular session. You can read more of my bio on your own. Some of the valuation questions that we will try to address today are the following discussion topics. We will review a brief overview of the major valuation methodologies in valuing a company. We will focus on the concept of enterprise value versus equity value, a very important distinguishing factor here. And in fact, if I were you, I would just put a star next to enterprise versus equity value, an extremely important component. We will also briefly discuss the capital structure and the concept of leverage, as well as your basic corporate finance fundamentals. We'll go over a brief discussion of the valuation multiples and implied valuation. Some of the questions we will ask is, how much is a company truly worth? Is it just its current stock price or is it not? How do you tell if a company is undervalued or overvalued? And of course, what is the appropriate premium to buy all of a company's stock? Some of the first questions you might want to ask yourself is, how would you define value? How would you define the value of a stock as well as a company? Towards the end of this session, we will look at an actual case study of Ultramarsh Diamond Shamrock, a refining company, being acquired by Valero Energy Corporation back in 2001. This was a transaction in which Bank of America Securities acted as a sole exclusive financial advisor to UDS in this particular deal. For more information on this, as well as the full transcript of the fairness opinion presentation, as well as the analysis behind this, you may feel free to direct yourself to the SEC EDGAR site, search for Ultramarsh Diamond Shamrock, and download the definitive M14A proxy filing dated August 24, 2001 for the full context and for the full text of this particular deal. However, before we go and enter into our full discussion on this particular transaction and how UDS was valued, let us first go through and make sure we have the fundamental core knowledge of the basics. Folks, valuation is a highly subjective process, and this requires a significant amount of judgment. This is where some shameless self-advertising for investment bankers comes into play. In theory, bankers have the ability to sell the story and properly negotiate the deal. Therefore, from that aspect, you always want to make sure that you have the well-qualified professionals advising you. In general, we always want to use a reasonable and defensible reality check. This reasonable and defensible reality check is extremely important because you need to make sure that if you're presenting in front of the board of directors of a Fortune 100 or Fortune 500 company, pretty clearly the CEO, CFO, and the board of directors are going to know about their company better than you will know about their company. So therefore, you want to make sure that your assumptions, your inputs, and your outputs are all reasonable and that you can actually defend them. In general also, by the way, valuation is always a range of values and never a specific dollar amount. People will have different ideas on value depending on the public status of the seller and buyer, how it was negotiated, was it a beauty contest, and of course, industry dynamics. Ultimately, at the end of the day, folks, always keep this in mind. There is no one right answer. There is no one right value. The question always is, what are you willing to pay? Now, let's turn ourselves to the basic valuation methodologies. On the one hand, we have basic trading comps. Trading comps are analysis of selected publicly traded companies. What this means is you take a look at the current publicly traded competitors and you see what the value of the market is, what the value the market is placing on these companies are at that particular moment. Then you take those multiples that are implied from the current observations that you make of the open market. Then you go ahead and apply the same valuation multiples and metrics upon the company you are trying to analyze. We will see actual live examples of this. Also, there are deal comps. These deal comps are a similar process as the trading comps, except instead of using publicly traded firms as your competitor, what we're going to use is, let's take a look at previously announced acquisitions in your sector. In addition, we'll look at a discounted cash flow analysis. In the discounted cash flow analysis, what that does is we will see how much we believe the intrinsic value of our firm is going to be, the intrinsic value. You can also say that the trading comps and deal comps, both of these are on top, is what we will call relative valuation. It's called relative valuation because we are looking at our competitors and seeing on a relative basis how much should we be worth. Both the discounted cash flow and LBO analysis are what we will call fundamental analysis. In this fundamental analysis, as well as the breakup analysis, what we're trying to figure out is fundamentally what do we believe the value of the firm will be. Leveraged buyout analysis is also somewhat similar. Leveraged buyout analysis takes a look at the core profitability and the core ability of a company to generate cash flow and then say, let's take those cash flows, leverage this company up a great deal, and use the internally generated cash flows to pay down the debt, hence building our equity. We will have a brief discussion on LBOs towards the end of this particular module. For more information on leveraged buyouts, as well as a fuller explanation of the things you must consider when building a leveraged buyout model, please refer to our module titled LBO Overview. In addition, we also have a breakup analysis. In this breakup analysis, what we will do is we will take a look at a conglomerate, for instance, and we will break up each one of their business units into disparate pieces of businesses. For instance, if you were to try to value a firm like GE, how would you do that? There is no one good competitor that actually builds engines for planes, as well as consumers for credit cards, as well as light bulbs and washing machines, etc. So from that perspective, it would be very difficult, if not near impossible, to pinpoint a very good competitor to use for comparisons against GE. So in that particular case, what you might do is you might separate and break apart each one of GE's disparate businesses, value each one of their businesses based on the previous methodologies, and then sum them up. Therefore, this breakup analysis is also called sum of the parts valuation. Finally, you would also look at asset valuation. If you have a company who has specific hard tangible assets, for instance, refineries, car manufacturing plants, etc., warehouses, you might be able to take this and say, okay, if there's an actively market traded for these particular types of tangible assets that you can split apart from the business, then let's go and see if we were to build all of that up from scratch, how much would this firm be worth? There's another comment, another bullet that I want you to add at the end of this bullet, 4 words. I want you to write in the words as a big bullet: distressed, restructuring, turnaround, or liquidation. Each one of these 4 are very similar to each other, but they are not on this slide for a specific reason. Because what we are trying to value is the value of the company as a going concern. Steady run rate, they will be around. They are not in any financial trouble. They're not distressed. They're not in a restructuring situation. They're not in a turnaround mode, and they're not in a liquidation method or bankruptcy. So from that perspective, just keep in mind that here, that it's entirely separate discussion on how to value distressed and restructured companies. So for now, for this particular module, we will focus on an ongoing run rate current valuation of a firm, and we will apply each of these valuation methodologies on top of that firm that we're going to analyze. Moving ahead to the next slide, what we now see is a slide on enterprise value and equity value. Folks, this is an extremely important slide. If you want, just put a big star and say must know. You must know this slide in and out. So where do we begin? First of all, we'll look at equity value. Equity value is simply price per share times the shares outstanding. Other terms commonly are known as market value as well as market capitalization. This one you should have already known what the formula is. And folks, if you didn't know what this is, just pretend you do, because this is a fundamental core concept. Price times shares outstanding gets you the equity value. Market cap, market value, synonymous terms. Now I want to address a particular point, enterprise value. What we actually care about in the valuation of a firm is the enterprise value, not just the equity. What is enterprise value? Well, I always say that finance is not rocket science. We just like to pretend it is to justify our high pay. What I mean by that is, if you look at each term in finance, and if you were to ask yourself, what exactly does this mean? It is very straightforward. Define it using itself. What is enterprise value? Very simply, it's the value of the enterprise. Now, I know what you're thinking. My 7th grade English teacher would come up, smack me behind the backside and say, nope, you can't use your own words to define itself. But when you truly think about it, it actually makes a lot of sense. What is the enterprise? Enterprise is the entire operation, the entire firm, the entire company. So what we were trying to value is the value of this entire operation, the entire enterprise. Now, said more concretely, what we are trying to really capture on our slide is to say that enterprise value actually equals all forms of capital. Enterprise value equals all forms of capital, of which equity value is merely but one component of equity. The definition of enterprise value, sometimes commonly known as levered market cap as well, is simply the equity value plus net debt plus preferred. To this, I will add another term called minority interest. And when we look at minority interest, here's what we want to see. Here's what we mean by this. We want to say form of capital is equity value. That's one source of capital that we receive to fund and to build our business. We also needed debt. We also may have issued preferred. And I'm going to come back to this minority interest in a second. Other terms for enterprise value are also called aggregate value, total capitalization, leverage value, or transaction value, but this is more in a deal context. Now, let's take a look at exactly what this means. Note that this diagram is not drawn to scale, but we have equity value, which usually is the core of where we get our money from. To that, we also add net debt and preferred stock. Usually, when we ask somebody, what is the value of, let's say, Microsoft, people would just say, oh, it's $25 a share or whatever the current stock price is. Or they might actually give you that market cap and multiply by the shares outstanding. But that is not the correct number. That is only one component of capital. A firm will get their sources of capital from multiple sources. Again, equity, preferred, net debt, etc. To which we add minority interest. Let me come back to that in a second. And so when we look at enterprise value, this means that, again, the entire value of the entire firm, the entire operations, the enterprise, whereas equity is merely but one component of capital. Very important here. Now, if all of these forms of capital make up the enterprise value, there's two comments now to make. Why do we include minority interest? What is minority interest? And also, what is how do we want to include and treat capital leases? For that, let's turn to an exhibit here. Let's take a look at what we exactly mean by minority interest. Remember, I gave you a definition of how to define everything. Take itself, switch it around. What is minority interest? Minority interest is simply interest at a minority. Okay, what does that really mean? What that means is, let's say I have a company. Let's say I'm Walmart. Walmart owns, hypothetically, 60% of a Japanese retailer called Seiyu. Because they reach 60%, once you reach 50%, you must consolidate all of your financials of that subsidiary onto your books. In other words, 100% of the income statement, the balance sheet, and the cash flow must be included in this calculation in your financial statements. If 100% must be included, however, we only own 60%. So that means 40% of this on the income statement will go out as a minority interest expense. Think of this as a quote-unquote dividend or the pro rata share of the minority stakeholders' share in that particular subsidiary. However, for purposes of valuation, we also want to include this number in our quote-unquote net debt numbers. It's another form of capital of enterprise value. Why exactly is that the case? Well, because the U.S. and international GAAP says once you reach 50%, you must consolidate. Well, if that's the case, on the balance sheet, I might have, let's say, hypothetically said, oh, I bought this company for $100. However, that was the total valuation. I only spent $60 because the $60 is what I only own 60%. That must mean that there's $40 on the books that will show up now, also called minority interest investments or minority interest on the liability section of your balance sheet. In other words, because you were forced to consolidate 100% of the income statement, the assets, the liabilities, as well as the cash flow. Because you were forced to consolidate 100% of that, all of the value must be placed on your balance sheet. If 100% must be placed on the balance sheet, well, I have to take a deduction in order for me to balance, because 40% of that, $40 in this case, is actually owned by somebody else. So now the question becomes, why do we want to include this $40 into our enterprise value calculation? We want to include this enterprise value calculation, this number in there, for the very simple reason that this is another quote-unquote form of capital used to get me that 100%. In other words, this is a form of capital that grossed up my income statement and balance sheet to reflect the full reported numbers. And because of the accounting systems, because this has to be grossed up to 100%, the full reported method, $40 of this liability, you can treat it as if I borrowed, quote unquote, as if I borrowed this $40 to fund the 100% acquisition of this company. Because I had to get 100% of this onto my books, it's as if I borrowed this $40 to fund 100% of the acquisition. And because I borrowed that $40 to fund this acquisition, that is why we would treat this as if it were debt. Now, that doesn't mean that it is debt. It's not an interest-bearing negotiated security. However, this is in our enterprise value. This is what we were trying to figure out. What is the full capital used to fund my entire business or my entire enterprise? And that is why you want to include minority interest. Now, another point that people always ask is, aside from minority interest, fine, I understand that this is a form of capital used to fund my business, so include minority interest in my total enterprise value calculation. In other words, if I had to reproduce all of Walmart's financials, all of my target company's financials, how much capital do I need to rebuild this firm? I need to have borrowed from my equity guys, from my debt guys, from my preferred, as well as from minority interest to reproduce the exact financials that this firm now has. So then another question becomes, do you want to include capital leases? Capital leases, let's take a look at capital leases. What are capital leases? Well, leases that are capital, that is how we would describe what a capital lease is. Now, what exactly does a lease that's capital mean? Well, folks, think about this. The accounting definition of capitalize simply means what? What does capitalize mean in accounting? This means put on balance sheet. So on the one hand, we have, of course, the flip opposite of capital leases, and that will be an operating lease. And this operating lease, what is an operating lease? It's simply a lease or rent. Let's say I have a $4,000 copier, and I choose to pay, let's say, $1,000 a year for 4 years, so I don't have to own this copier. I will take this copier and I'll rent it for $4,000. On the flip side, if you meet certain accounting rules, you have to capitalize or put this on the balance sheet as if you bought it. As if you bought it. This doesn't mean you bought it. It's still a lease. It's still rental. However, the accountants want you to say, if you meet one of these 4 criteria, which we'll quickly go over, if you bought it, then you have to capitalize in the balance sheet, so your assets via PP&E will actually increase, and your liabilities, capital lease liabilities, will also increase. Let's just say hypothetically by $4,000 each. Now, the accounting behind capital leases and the split of imputed interest and depreciation is actually a little bit more complex. So just note that we are going to simplify this analysis. So the question becomes, why are capital leases not ideal? Generally speaking, this shows a higher asset base. If the asset base is higher, and if you recall from our accounting module, this means that you will show lower efficiency and lower asset management turnover ratios. Lower efficiency and lower asset management turnover ratios. So that is why we generally try to get this off the balance sheet to reduce our capital base. So for instance, return on assets might be a little bit lower. Also, because now you have a liability, a quote-unquote debt that appeared on the books, this will also affect your capital ratios. And this will show that you have more debt. And we, of course, do not like to show the fact that we have more debt. So for these 2 basic reasons, generally speaking, firms do not like to have to capitalize their lease, because you have, again, lower efficiency ratios, lower asset management turnover ratios, such as return on assets, and of course, you now have to show additional debt. Now, if we have said that capital leases are not necessarily ideal, what are the 4 reasons, one of 4 reasons that you would need? If you meet any one of these 4, you have to now capitalize the lease, treat this operating lease as if you bought it, put it on the balance sheet. So here we will say, if you are a snob, you will basically have to capitalize this lease. A snob, 75% of your useful life. For instance, if this copier had a useful life of 5 years and I decide to lease it for 4 years, that is, 80%. So therefore, the accountants say, well, you are effectively buying or using the entire life, or 75% of it, and therefore you are not going to be able to get away with just treating this as an operating lease. It's as if you bought it, because you're substantially using a huge amount of the useful life. N stands for 90% of fair market value. Folks, if this lease is, if this copier is a $4,000 lease, and in total, let's say I'm paying $3,800, assuming 38 over 4,000 is greater than 90%, they're saying, hey, it's as if you effectively paid for the entire copier. You must now capitalize this, treat it as if you bought it. O stands for ownership. If there's a transfer of ownership, if the transfer of ownership at the end of this, free and clear, at the end of this operating lease, it is yours, then again, they treat it as if you bought it. Finally, if there's a bargain purchase price, for instance, at the end of the lease terms, you can buy it for $100 or $1, it's yours, free and clear. Again, if you meet any one of these 4 criteria, the accountants will say to you, you have to make sure, or you have to capitalize this lease as if you purchased the entire asset. Now, if we have proven that this capital lease and operating lease, the only difference, again, the only difference between this capital and this operating lease is the mere fact of these random, quote-unquote, random 4 accounting rules as dictated by the FASB, the Financial Accounting Statements Board. The FASB had these 4 rules, these snob rules. So what we are saying is from an economic perspective and from a financial analysis perspective, from an economic and financial analysis perspective, the difference between an operating lease and a capital lease is nothing. No difference between a capital and an operating lease. And if there's no difference between an operating and a capital lease, then we are going to effectively treat the capital lease as if it were an operating lease. Now, I know some of you may be thinking, well, we do actually want to include capital leases. We do want to include the effect of capital leases. Or, rather, on the operating lease side, we want to say maybe we should add the operating lease back. But again, keep this in mind. When we are looking at enterprise value, going back to the context of this now, when we are looking at enterprise value, what we are ultimately trying to capture is the sources of funds from a financing perspective that I used to gain all of my assets. Whereas an operating lease is still a operating related decision. I need to make photocopies. It's not a financing decision. Now, one could say, well, this capital lease, you needed to fund this copy or somehow. If you didn't lease it, rent it, you would have to buy it and you would have to borrow money potentially to do that. I can't argue with that approach necessarily, but the idea there again is that's an operating related decision for that particular decision on whether or not I needed to run my operations, make photocopies, etc. But what we're trying to capture again is the financing aspect. How did I grow my business initially? Where did I get all the sources of capital I needed to actually grow and build my business? So therefore, we want to look at it from a financing perspective. Whereas this capital lease is still an operating related decision. I need it for my day-to-day operations as opposed to how do I fund the growth of my business. Slight subtle nuance there. But again, keeping this in context of the enterprise value calculation, that is why we want to make sure that here we want to include minority interest. So on the top here, you can add another box and say minority interest. Because why do we want to include minority interest as a summary? Again, we want to include minority interest because this is another form of capital used to get 100% of our profitability and our balance sheet. Because why? Greater than 50%, we have to consolidate. Likewise, we want to make sure we exclude, or rather do not include, the effect of capital leases because the difference between a capital and operating lease is purely an accounting definition. And because this is an accounting definition, it does not impact our ability to fund the growth of our business through the financing related activities. So folks, please make sure that you solidly understand this concept of enterprise value, because at the end of the day, whenever we value companies, we always want to value the enterprise value. Then minus the net debt, minority interest, and preferred stock to then get us down to to equity value. Go from enterprise value minus net debt, preferred, and minority interest gets us to equity value. Then from equity value, divide by the appropriate number of shares outstanding, which will then get us our price per share. We rarely want to go the other way up when we're trying to value a standalone company. So this concept of enterprise value, it's the entire firm, the entire enterprise is what I am acquiring, not just the equity component. Moving ahead to capital structure, what we now see is that capital structure is simply what? What does this mean? It's the structure of capital. And again, you may be wondering, well, that's not a very value-added explanation, but what does capital mean? Capital equals money. Why do we care about a firm's capital structure? Because this refers to the sources of funds required to run a business. And again, this will tie back into our concept of enterprise value. And throughout the next half hour, I will constantly wrap back and refer back to enterprise value and put it in the right context before we look at our case study. Common forms of capital include equity, debt, and preferred, as we already talked about. Equity, recall, that symbolizes ownership of a firm or of an entity by the investors. That is borrowed money with interest, and preferred stock is actually a combination. Here in this context, I will not necessarily go into a full explanation of preferred stock. There's plenty of language written in any finance textbook there. But another point I want to keep out is why do we care about capital structure? Simply because capital is not free. Each component of the capital structure, this equity, debt, and preferred, that has an associated cost. So you want to make sure you properly capture that. A quick note on debt. Debt holders, as we know, has a first claim of assets before equity holders. Within debt, there's a different priority of liquidation as well. There are numerous tranches of debt. Securitized loans, for instance, this is usually the most secure. The most secure because there's a specific hard asset like a building, for instance, or accounts receivable that is backing that particular security. So if the company goes bankrupt, that bondholder or that holder of this securitized note will actually be able to get paid back because they have specific collateral that is backing that particular financing source. Revolver is considered a line of credit. It's a revolving line of credit, credit card for the bank, for the company rather. And this is considered to be high on the priority list. Why? Because this is extremely short term. This is usually the first thing that the banks will require you to pay back if you are having problems. So therefore, it's the first to get paid. Term loan is also, this is primarily from a bank loan, and they are amortization periods, meaning that you have to prepay, or there's a fixed amortization of your principal. Compare and contrast that with the senior and junior debenture, simply meaning a regular unsecured bond or a regular corporate note. And this corporate bond basically says, typically, we have what we call bullet payments. You pay all your principal back at the end. And because you are paying back your principal at the very end, that is going to be junior compared to the term loan issued by the bank, because the bank would have already gotten back some of their money. Then, of course, you have senior and junior sub-debt, what we call high yield or junk bonds. High yield or junk bonds. And then underneath that, you have your preferred stock, which gets paid after all the debt holders get paid. And then at the very, very bottom, you would have your equity. So this is a very quick summary of the priority of liquidation. Moving ahead to the concept of leverage now. Folks, think about leverage. Leverage is a word that I don't know I can quite define using itself. Leverage obviously is leverage. I mean, how else will you define it? Leverage is the use of debt to fund operations. Here's how I define the word leverage and how I crystallize it in my head. Now, don't laugh when I do this. But basically, think about this. I have a big rock over here, and I have a tiny little rock. And then I have a little board, and I'll take this stick, and I will use the small rock and the stick to leverage and move the big rock. How do you like that definition? All right. I know that's not that good, but the concept is the same. We are using something to move something that is bigger. What exactly does that mean? Again, leverage is the use of debt to fund operations. Now, all you have to remember is leverage equals debt. So, what are the advantages of using debt? Well, first of all, debt is usually considered to be cheaper than equity. Why is debt considered to be cheaper than equity? Simply because debt has to be repaid and therefore is less risky than equity. Debt has more known cash flows. You know when and you know how much you expect to get your money back. Whereas with equity, you don't know how much and you don't know when. Another advantage of using leverage is simply that the interest on the debt is tax deductible. In other words, the tax savings on interest payments are not insignificant. They do add up to quite a significant amount. Because debt is cheaper and also because of the tax deductibility aspect, the entire weighted average cost of capital, in other words, the discount rate on this firm, for this firm, will actually be significantly lower than if you did not use debt. And if you recall basic M&M theory, if you remember, basic M&M theory says what? That the ideal capital structure, absent transaction costs and taxes, should be 100% debt. That's not always realistic, of course, because then you look at the modified theory, which then says, okay, it's still a little bit more efficient than using 100% equity. And we'll talk and crystallize in a couple examples when we look at the basic corporate finance of exactly what this means and why debt is good and why it is also bad. For more detailed explanation on our WACC discussion for our discount rate, please feel free to refer to our module, Finance 101, Introduction to Finance. The last, well, there's probably a lot more, but the last major advantage of debt is the simple fact that it reduces your upfront cash injection. In other words, this means that you can actually use less of your own money to start a business to fund a particular project. And again, we'll speak a lot more about that in our corporate finance section coming up in a few slides. Let's now talk about the disadvantages of leverage. First of all, if you have too much debt, this becomes an issue. Why? Because the interest and principal payments and repayments can become a cash burden. If this can become a cash burden, this means that now I have to manage my cash flow and I'm not able to concentrate on actually running the business. Debt holders control the company if bankruptcy is declared. Debtors have liquidation priority, as we spoke about. And debt covenants can be very restrictive. What are debt covenants? Covenants are basically a promise. There are two types of major covenants, affirmative as well as negative covenants. An affirmative covenant simply says you must do this. I must do something. So, for instance, I must run the company. I must, I must run the company well. I must maintain profitability. I must go ahead and give you financial reports every now and then, etc. Negative covenants say you cannot do this. I cannot pay myself an excess dividend or excess bonus before I paid off your interest. I cannot go and buy another company without your approval. I cannot go and issue debt senior to you, again, without your approval. So these can become very restrictive at times and hamper the company's flexibility to run their business. The more debt, the riskier the company, the risk of default, of course, increases. And of course, this is where leverage must be managed correctly. And that is where corporate finance comes into play and why CFOs get paid the big bucks. because at the end of the day, it is their job to make sure that the company has the right optimal mix of debt and equity. And for this now, what I would like to do is let's turn to a sample case study to iterate some of these concepts that we've talked about. The sample case study is as follows. Let's assume we have two firms that are exactly identical in every possible way. Both firm A and both firm B produce cars and are exactly the same except for the capital structure. Firm A and B both require $1,000 of startup cash for expenses such as rent, legal fees, office supplies, etc. Mr. A decides to put in $1,000 of his own money to start firm A, and this is what we will call an equity injection of $1,000. Firm B now decides to put in $500 of his own money, equity injection of $500, and raised $500 of his debt from his bank at 10%, debt raised of $500. Keeping it consistent with the financial jargon, the capital structure means or is said that firm A's capital structure is 100% equity and firm B is 50-50. So based on this very simple analysis here, let's now take a look at a sample comparative financials. Now, you may not be able to see this on the screen all that well, but you should have a printout of this that you'll be able to refer to and to jot down your own notes. Let's say that we are now in a good economy. Good economy, firm A with no leverage, meaning no debt, has sales of $1,000. COGS of $500, gross profit of $500. Compensation, SG&A, and other expenses total $300, giving me operating income, also known as EBIT, of $200. Now, keep this in mind. I do not have any taxes. Sorry, I do not have any interest. Why do I not have any interest? For the very simple reason that I have no debt. I have no debt on the books here. Therefore, my pre-tax income is going to equal my operating income. Taxes of 40%, $80. My net income is $120. Now, let's take a look at firm B. Recall, firm A and firm B are exactly the same, except for the capital structure. So that means that when we look at our sales of $1,000, they are exactly the same. All the way down to operating income, EBIT, $200. For a fuller explanation of the importance of EBIT and EBITDA, please make sure you refer to our accounting module, Accounting and Financial Statement Integration, in which we talk about the exact difference between EBIT and EBITDA, and more importantly, why they are extremely critical and important. But real quick refresher here, EBIT is simply core, recurring, sustainable, profitability to the entire company before the effects of capital structure and leverage. Again, core, recurring, sustainable profitability to the entire company before the effects of capital structure and leverage, meaning that before we include the capital structure and the mix of debt and equity, these two firms should be exactly the same. And why should they be exactly the same? Well, very simply, because up until that point, operating income or EBIT is before the effect of interest, and therefore we have not yet at this point considered their differences. EBITDA, real quick, by the way, as we know, is a proxy for cash flow. Again, this is more fully explained in our accounting module. Proxy for cash flow, again, to the entire company before the effects of capital structure and leverage. So when you look at it from this perspective, keep in mind that firm B have $500 of debt, 10% interest rate, $50 of interest expense that they now owe the banks. So when we look at it there, firm A and firm B, up until operating income, are exactly identical in every possible way. They are the same firm, except now when we start getting to our capital structure via interest expense, firm B now actually has interest expense of $50, thereby decreasing their pre-tax income to $150, taxes of $40, net income of $90, and of course that is all summarized right here. Now the question becomes, which firm is more profitable? Firm A or firm B is more profitable? And when you look at it, you can say, well, here's one way to look at it. It is very clear that the absolute basis, firm A made $120 versus firm B's $90. So you can clearly say that on an absolute basis, firm A made more money. However, we want to look at this also on a relative basis. And what we're now saying here is the fact that firm A put in $1,000 of equity and has a return on equity of 12%, the 120 over the 1,000. However, firm B, Mr. B, only put in $500 of equity and therefore has a return on equity of $18. Now, keep this in mind. This does not mean that ROE is the holy grail. This does not mean that ROE is the one and all answer to and the statistic and ratio that you should look at. It is not. Now, the question becomes, why is this going to be good or bad? You can clearly see that firm B has made a lot more money here on a relative basis. They have a return on equity of 18%. And if you were to look at it there and you say, well, I didn't get my $120, but if firm B, Mr. B rather, were to go and start another firm exactly like firm B, and he puts in the same $1,000 of equity, he would now have $180 instead of his $90, thereby giving him the same $1,000 equity injection, $180 of net income of profits. So now, this is in a good economy. Let's take a look at what will happen in a bad economy. In a bad economy, we look at it and say, well, we kind of kept it simple. We said, every one of these numbers in firm A, we just said divide by 3. So that means a 67% decrease in their profitability as well as their expenses. So you will now note that sales is $333, operating income is $67 versus the $200 and the $1,000 on top. And instead of making $120 in net income, we now only made $40 in net income. Keep in mind the interest expense is still 0. So this is a bad economy. We did not do so well on these financials. Now let's take a look at how firm B did. Well, keep in mind, firm B is the exact same as firm A. So that means from sales all the way down to operating income, they have the exact same profitability. What this means is, now, because the banks will not say to you, oh, don't worry, you lost 2/3 of your profit, just pay us 2/3 of the interest expense you would have owed us. Fat chance. So therefore, interest expense stays constant at the $50. And because that stays at the same $50, what we now have seen is that net income will drop to $10. And when we see that net income has dropped to $10 versus firm A's $40 net income, you can clearly see the dramatic difference. The ROE of firm A in a bad economy is 4%, $40 divided by $1,000 of equity. Firm B, however, has dropped down to 2%. Now that it's dropped down to 2%, you can clearly see in a good economy, firm B did better. In a bad economy, firm B did worse. Now, it gets a little bit more dramatic here. Why does this get more dramatic? What have we assumed about these financials? These expenses we have assumed are what type of expenses? We've assumed that they are all variable costs. Again, we have assumed that they are all variable costs, except for this interest fixed cost, and hence you have to decline. In reality, especially if you're a car manufacturing firm and your sales immediately drop that much, you probably don't have enough time to cut your expenses that quickly. So in reality, probably your expenses will be the same, if not even higher, because now you have to lay off and restructure, and you have other shutdown costs. So when you look at it there, these numbers will actually be grossly negative upon the net income. They will both be hugely negative. But who has maintained flexibility at the end of the day? It is pretty clear that firm A has a lot more flexibility. Firm A can now say, well, they can go back to the banks and say, hey, this is a temporary thing. Let me go and figure out, this is my business plan on how I intend to get back to profitability. So let me go ahead and give me some money and I'll prove it to you. Firm B, on the other hand, is going to have severely limited flexibility. They won't have the ability to do that. They won't be able to go to the bank and say, hey, give me one more shot. They're like, no, you barely made it out this year and you still owe us a whole ton of money. So when you look at it there, the key to remember here is also the volatility of the earnings. Taking a look at our numbers again. Whose figures are more volatile? Firm B has gone from 18% to a 2%, whereas firm A went from 12% to 4%. Pretty clearly, firm B is a lot more volatile in their earnings. Because they're a lot more volatile, they're also going to have a lot more risk and uncertainty. Because why? Their profitability is a lot more dispersed and a lot more widespread, whereas firm A is a lot closer together. So here, this again is where it is up to the CFO of the company to properly manage the right optimal mix of debt and equity. What this means is, in a good economy, you want to make sure you're able to maximize your earnings, and in a bad economy, or when the crap hits the fan and you aren't making as much money, you want to make sure now you minimize your downside. And this optimal mix of debt and equity, that is always a tricky thing, but that is how the capital structure now all comes into play and also affects the entire valuation of the firm on the enterprise value. Let's now take a look at valuation multiples. A multiple is simply a ratio. One of the most commonly quoted and cited ratios is simply your price to earnings multiple. Price to earnings multiple is simply a multiple of earnings. However, there are also numerous other multiples such as sales, EBITDA, and EBIT. And this is one of the key concepts here, especially when we look at relative valuation. What this means is the price to equity simply says if a stock's PE is 20, that means you are basically paying $20 to get $1 of earnings. Said another way, it would take you 20 years to get your money back, forgetting about discounting. 20 years to get your money back. Now, in general, as we know, the higher the multiple, the more the investor is willing to pay for the stock of the company. Why is this the case? For that dollar of earnings that younger firm, that younger higher growth company made, what we're saying is they have the potential to make a lot more in the future. And that is why we are usually willing to pay more for their dollar. However, a lower multiple can be attributed to a slow growth, mature, or even negative, stable company. Why? Because for that extra dollar, for that dollar of earnings, it's going to be that much harder to earn a good return on that in the future. It will not appreciate as much or has less potential. And therefore, this is one way to gauge market sentiment as to see which firm is being placed at a premium. Real quick note on this. Multiples are either forward-looking or backward-looking. Backward-looking multiples, or what we call trailing multiples, use earnings that have been realized in the past. In other words, for instance, the last full year of earnings or the last 12 months LTM. What this means is, if a stock price is currently at $20 and last year's earnings per share EPS was $1, the PE ratio is simply 20 times. However, using forward multiples, because we never want to pay for previous earnings, we always want to pay for future earnings. If the stock price is $20 and it's estimated to have earnings per share of $2, this means that I have a PE now of 10 times. So it's very important to make sure that when you're looking at PE ratios or any multiples that you're always comparing apples and apples. You want to make sure you compare apples and apples. Now, let me go into a quick sidebar and discuss why I believe PE ratios are suboptimal as a valuation metric. Go back to our previous discussion on corporate finance, and when we looked at the optimal mix of debt and equity and said, well, you know what? Think about this. Net income divided by shares outstanding, as we know, gets us our earnings per share. How much net income, how much income do we make on a per share basis? Well, if you look at it from that aspect, don't forget, net income has already been reduced by taxes as well as our interest expense. In other words, net income has already taken out the effect of our financing and our funding. And if you were to quickly look at our previous numbers here, so let's look at our previous set of numbers, and we look at this and we say, if we were to compare using purely PE ratios, in other words, using our net income, $120 of net income versus $90 of net income for firm A and firm B respectively, one might say without any additional information that firm A has a higher net income and is a little bit bigger. But we know at the end of the day, in reality, operating income of $200 each are exactly the same. Again, firm A is the same as firm B. However, because we are using this on an after interest, on a levered basis, we are looking at net income, which is our earnings per share. We're looking at this after the effect of interest expense, which that simply means that we have not actually fully encountered and fully looked at the core ability of the company to generate profits. Think about that once again. I believe that PE ratios are suboptimal because it has removed the effects of financing already, and I'm not able to truly ascertain, based on just that PE or that EPS number, exactly, or that net income number, exactly who is a larger company. As it turns out, firm A and firm B, as we already demonstrated, are exactly the same size. However, you cannot tell that by looking purely at the net income or earnings per share. And therefore, using the PE ratio as a form of valuation metric or the sole source is very, very unideal. Now, there's an emphasis placed in the market today that PE ratios are everything. PE ratios, PE ratios. So just keep that in mind. There are other ratios that we want to also utilize. As we have already said before, you want to also look at EBITDA and EBIT multiples because this reflects your proxy for cash flow, core ability for the company to generate cash flow, and your core profitability of the entire company. Now, in the next few slides, I will reiterate this concept and wrap it back to enterprise value. And more importantly is, why do we care about all of this? Because enterprise value is extremely important. So let's take a look. In this example here, using the same numbers from the previous case study, we have already talked about the fact that we need to make sure that we're looking at multiples. Our forward-looking and backward-looking multiples must be aligned correctly. Let's now take a look at the numerator. This is where the distinction between equity value and enterprise value becomes extremely apparent. In the following example, as we have already stated, firm A has no debt, and therefore enterprise value is equal to equity value. However, using equity value to calculate a revenue or EBITDA multiple for firm B will result in a grossly incorrect multiple. Let's take a look. Firm A, who has no leverage, their equity value is $1,000. They have no debt, so their enterprise value is also $1,000. If I were to take this equity value of $1,000 and divided by my revenue, EBITDA, and net income statistics here, this will yield me the following ratios. In other words, 1,000 of equity over 1,000 of revenue gets me 1 times. 1,000 of equity over 300 EBITDA. We basically assumed that the DNA was $100 because if you recall, EBIT was $200 from the previous set of numbers, and therefore the actual EBITDA is going to be $300. So now I would take $1,000 of that equity divided by the 120 of net income, and that gets me 8.3 times. This got me 3.33 times. Now, if I were to take the same $1,000, but now from the enterprise value, divided by each of these 3 statistics here, I will get the following multiples, and of course, they are exactly the same. Think about that, folks. Why are they exactly the same? Well, they're exactly the same for the mere reason that equity value and enterprise value are exactly $1,000 each. So therefore, no matter what you do with your numerator, it's the same absolute value divided by the same denominators, revenue, EBITDA, and net income, you will get the same multiple. But now what I want to do is let's take a look at firm B. Firm B, as you recall, has $500 of equity. They have $500 of debt, meaning they have enterprise value of $1,000. Revenue and EBITDA are exactly the same at $1,000 and $300. Why are they exactly the same? Don't forget, this is before the effects of interest and taxes. So, of course, we have not yet taken away the debt that we have on the books of the $500 or the interest expense. And therefore, they're exactly the same. And as you recall, net income of $120 for firm A was comparable to firm B's $90. Now, the question becomes, when we go ahead and say, what is the equity value divided by $500 of equity of firm B divided by these 3 statistics, what ratios do I get? I get the following numbers. I get $500 divided by 1,390 gets me these numbers. 500, for instance, divided by 1,000 of revenue, that gets me a 0.5 multiple. 500 of equity divided by $300 of EBITDA gets me 1.67, so on and so forth. Now, when I do the same thing, however, and I take a look at the enterprise value of $1,000 divided by the same numbers, these are the multiples that I now get. So again, the difference between firm A and firm B was the fact that we had debt for firm B. So now what I'm saying to you is if I simply took the equity value of $500 of firm B divided by each of my statistics from firm B, I will get a set of ratios that is going to be incorrect. That is different from firm A. Firm A didn't matter which one you took because equity was equal to enterprise. Now, note on our slide we have done the following. We have indicated which one of these multiples were wrong and which one of these multiples were correct. So this can be summarized as the following. What we are trying to say is that the enterprise value divided by revenue and EBITDA is the correct ratio. In other words, enterprise value and EBITDA, these are the correct ratios to use. Likewise, for equity value, or conversely, for equity value, the only correct is for net income. That is this number down here. And now, the question I will pose to you is, why is it that enterprise value is the correct numerator when you're trying to figure out revenue multiples as well as EBITDA multiples? And why is equity value the correct number to use for net income? Think about that, and then you can forward on to our explanation of why the numerator is going to be different for each one of these multiples. In addressing this question here, one must ask yourself, who has a claim on revenue and EBITDA? There are 3 stakeholders who have a claim on revenue and EBITDA: the equity holders, the debt holders, as well as the government on taxes. Yes, the vendors and suppliers and employees also have a claim, but we are assuming that that is part of the normal course of business because, again, we are talking about capital structure and the actual debts that are owed. So from that perspective, equity, debt, and government have a claim on revenue EBITDA. Well, how is the enterprise value constructed? Enterprise value is constructed by equity plus the debt as well. And of course, the government is just a liability you have to pay. Therefore, these cash flows and these valuations are now aligned: enterprise value, revenue, and EBITDA. Now taking a look at the equity value over net income. Who has a claim on net income? Only the equity holders. Why do only the equity holders have a claim on net income? Because the debt holders have already been paid, as well as the government. Why? Because the debt holders have already been paid their interest, and the government has already been paid their taxes. That's the net income number, the net number. So therefore, what is the only constituency base that has a claim on its net income? Equity again. Therefore, equity value is the correct numerator for net income. Said another way, revenue belongs to the entire firm or all capital holders at the bottom of the slide, as does EBITDA because it is before interest payments, earnings before interest and taxes. And therefore, the correct term to use for these guys would be enterprise value. And also for net income only belongs to the equity holder since it's after interest payments, and that is why you must properly align the multiples. Once again, let's say that again. Revenue belongs to the entire firm, all stakeholders, all capital holders, as does EBITDA. And therefore, who has a claim on this firm? The enterprise value. Everybody who has a component of capital that contributed to enterprise. However, for net income, because it's after the taxes have been paid to the government and after interest expense, after the debt holders have been satisfied, this now means who is the residual claim on this? That, of course, is the equity holders as well, and that is why you must properly match the multiples. And if you were to not properly match the multiples, looking at our firm B, right-hand side, you will see that you have incorrect multiples that are grossly inaccurate. So you must make sure you fully understand this term, enterprise value. Once we have finished calculating our enterprise value, let's see how we would apply this and actually calculate the implied value of a firm that we are trying to analyze. This benchmark firm is basically our old firm B. This firm B, if you recall, has $1,000 of sales, $200 of operating income, net income of $90. EBITDA is the same $300, $500 of equity, debt, and an enterprise value of $1,000. Now, when we are to calculate these multiples, to take enterprise value of 1,000 divided by sales of 1,000, that gets us 1 time. Again, 1,000 divided by 1,000 equals 1 times sales or revenue multiple. Take the same $1,000 of enterprise divided by gross profit of 500 gets us 1,000 divided by 500 gets us 2 times. Likewise, 1,000 of enterprise divided by 300 EBITDA gets us 1,000 divided by 300 or 3.3 times. And lastly, enterprise value divided by 200 EBIT, operating income, gets us 5 times. So that is exactly how we calculated these multiples. Now, we look at equity value. If we were to take equity value of $500 divided by net income of $90, this gets us 500 divided by 90 equals 5.56. And now we have calculated the actual multiples for our benchmark firm. Now the question that we pose to you is as follows. Let's assume, folks, that I have a hypothetical firm that is exactly double. This hypothetical firm, my target firm I'm analyzing, is exactly double my benchmark firm. It's exactly double my benchmark firm, and the question now is, what is the value of my equity, my debt, and my enterprise? Well, if this firm I'm telling you is exactly double in every possible way, what we want to now say is the following. How do we actually calculate the implied value? Well, we clearly know that if this firm is exactly double, then we know that this equity value should clearly be $1,000, and our enterprise value should be $2,000, because every one of these numbers are exactly double. From 2,000 to 400 versus 200, 180, 90, etc., 600 EBITDA versus $300 of EBITDA. Now, we can all do simple math in our head and double a number. But the question is, if this wasn't double, exactly how will we truly come up with these numbers? Here's how we will come up with these numbers. Here's how we will actually apply the multiples into our implied valuation context. The first thing we will do is to take the multiples we calculated for our benchmark firm. We will then take our statistic of $2,000 of the hypothetical firm, and we will then say, well, 1,000 times 2,000 must be $2,000. Then we will go ahead and take our gross profit of $1,000, grab it down here, multiply by 2 times the multiple we calculated for our benchmark firm, again giving us $2,000. EBITDA of 600 times 3.33, $2,000. 180 of net income, $400 of operating income times 5 is 2,000 again. All of this here will actually calculate TEV, total enterprise value. Real quick on abbreviations. EV is meaningless. Why is this meaningless? Because we don't know if you're talking about enterprise value or if you're talking about equity value. So therefore, the common abbreviation for enterprise value is TEV, total enterprise value. And if you want to shortcut equity value, you can say something like EQ, VAL, equity value. But just to say enterprise value would be misleading, just to say EV would be misleading since we don't know exactly what you're referring to. But TEV is what we always commonly refer to as total enterprise value. So when you calculate these multiples here, that is exactly what you are calculating, the total enterprise value. Why are you calculating the total enterprise value? Very simply. Don't forget simple algebra. You take total enterprise value divided by sales times my sales number for my hypothetical firm. These cancel out. I get my total enterprise value. So these numbers we had here were all $2,000. This actually calculates our total enterprise value. This is slightly different from now when we take net income. Don't forget, net income is $180. Net income's numerator is equity value. As we said before, equity value divided by net income times net income will actually get us our equity, will get us our equity value. And since that gets us our equity value, we will now look at this and say this is different from our total enterprise value. So moving on here, what we see is the following. The 180 of net income brought down times the 5.56 gets us $1,000 of equity value. To that, you will add your net debt from on top of $1,000. That is a book value number. That's $1,000 gets you a total enterprise value of $2,000. So no matter how you look at this, you will receive a total enterprise value of $2,000, which we already knew because we said this is exactly doubled. But this is the exact process that you would do this. Again, you would take your benchmark firm's multiples times your hypothetical firm statistics to then extrapolate our implied valuation of the firm. Quick reality check. In this case, we got $2,000 for all of these numbers on enterprise value. Why would you never get the same implied value for a firm using another firm's multiples? In other words, this $2,000 we got as the same number. Generally, you will get a variety of numbers here. But why? Well, it's very simple. You will never have a firm that is exactly scaled by proportion, meaning you will never find a firm, a hypothetical firm, that is exactly double your benchmark firm. Your sales might be exactly double, fine, but your gross profit, you may not have the same COGS gross profit margin. Let's say your COGS was $900. That means your gross profit is $1,100. Therefore, instead of using $1,000 here, you will bring this $1,100 in, and you would actually get a number. 2 times $1,100 would be $2,200. And therefore, your implied enterprise value would be $2,200 in that number there. You would do the same thing for all of these other profitability metrics. And when you do that, you will have a range of numbers as opposed to the same 2,000 or the same number for every one of these. Couple of quick things here that we want to point out. First of all, you want to make sure that you understand how to go up and down what we call the capital structure. You calculated total enterprise value initially. Remember, you want to then minus net debt and other forms of capital. That gets you to your implied equity value, to which you will then divide by your shares outstanding to get your price per share. Now, we also know that if you started with your price per share, you multiply by your shares outstanding, get you equity value. Add net debt, get you total enterprise value. That's the calculation we will do to get our benchmark firm. We will have to estimate based on the current market what the price is, what the shares outstanding is, add net debt, gets a total enterprise value. But then when we actually calculate the value of our hypothetical firm or our target firm, we always calculate total enterprise value on top, go down the capital structure all the way down to isolate stock price per share. We will see a pretty good example of this shortly. That's one major point you must make sure you keep in mind, that you're able to fluidly move up and down the capital structure via the total enterprise value concept and formula. You must be able to go up and down the capital structure. Now what I would like to do is take a very quick sidebar into this equity value over net income. Equity value over net income is a term that you actually already know but don't even know you know. In other words, equity value over net income is also known as what ratio? This is also known as your PE ratio, price to earnings per share. Why is your equity value and your equity value over net income the same as your price to earnings per share? What must you do to both numerator and denominator to arrive at this calculation? You will first of all divide both numerator and denominator by shares outstanding. And when you divide equity value divided by shares outstanding, you get the price per share. You divide net income by shares outstanding, you get earnings per share. But now the question I'm going to ask you is the following. Mathematically, financially, algebraically, and conceptually, equity value over net income is the same as price to earnings, your PE ratio. But yet, there are two major reasons why they are still going to be different. In other words, even if you take the entire universe of all publicly traded companies out there right now, and you were to put in the current stock price times the current shares outstanding to get to equity value, You take the earnings per share from the 10K filing, from the annual report filing. You multiply by the same shares outstanding they use to calculate net income. And you divide now, you will not get the same number on the left hand and the right hand side. Now, no devil's advocate here. We're all going to use diluted shares outstanding. We're going to use the same price, stock price that day to calculate our equity value. We will use the same shares outstanding they use to calculate earnings per share and net income on the same time period. There are no extraordinary items. There are no non-recurring. There are no discontinued. There's nothing like that. It's a very clean base case company. The question again becomes, why is it that these numbers will not equal each other? For that, we will turn to two different explanations, two different reasons to explain why this is different. First of all, recall, how is equity value and price per share actually calculated? You will calculate that by multiplying price times the current diluted shares outstanding. That will get you your equity value. Once you do that, you will then also take your net income divided by shares outstanding, also diluted shares outstanding, to get your price per share, or sorry, earnings per share. Now, if that's the case, we are using the same shares outstanding calculation in all cases. Why are they going to be different? Recall the following. Recall that the way net income is boiled down to earnings per share is via diluted shares outstanding. How did it calculate diluted shares outstanding? What we call WACSO. WACSO stands for weighted average common shares outstanding. And you will find this in any standard accounting 101 textbook, how to calculate earnings per share. In other words, what is this weighted by? Think about it. What is WACSO, weighted average common shares outstanding? How are they weighting this? The way they're weighting this is based on a four-letter word that starts with T, ends with E, and has an IM in between. That's right. WACSO, weighted average, it's weighted by time. This is a time-weighted shares outstanding calculation, meaning what? What this means is, if I have in January 1st 100 shares outstanding, December 31st I have 120 shares outstanding. Assuming I issued all 20 shares in the middle of the year, whether that's June 30th or July 1st, 20 shares, my weighted average is simply the straight average, because it was issued right in the middle of the year, is 110. However, if I issued all 20 shares on January 2nd, what this means is, what is my weighted average shares outstanding then? 20 shares on January 2nd. This is closer to 100, or is it closer to 120? The number will be closer to 120. Why? Because the vast majority of the year it was outstanding, all 20 shares. The actual calculation would actually be 100 plus 20 times 364 over 365, whatever that number turns out to be. If I issued all 20 shares on December 30th, is my weighted average shares outstanding closer to 100 or 120? It is going to be closer to 100 and not 120. Why? Because that extra 20 shares was outstanding for only one day of the year. So that would be calculated as 100 plus 20 times 1 over 365. That is how we calculate, or rather, that is how the accountants calculate the diluted shares outstanding number to go from net income to earnings per share. That is our WACSO calculation. However, when we calculate our current shares outstanding for our equity value, what we are always trying to capture is what? We are always trying to capture current valuation, current market value. If that's the case, do we care about this number? For instance, if we did issue all shares in the middle of the year, the denominator becomes 110. The denominator becomes 110. Do we care about this 110 number for purposes of calculating our equity value on top? We do not. Why do we not? The number we would use on top would be 120, or closer to 120. Why would it be 120? Simply because, if you recall at the bottom of our slide here, or at the bottom of our exhibit, we are going to say that the actual shares at the end of 12/31 is 120. That is the number we will actually use in our numerator, because we don't care for weighted average. We care about current. So let me reiterate that. That is the first reason why equity value over net income is different than price to earnings. Why is it different? Because the shares outstanding count is going to be different. On the numerator, to calculate price to equity value, you will use the current number of shares outstanding. The denominator, the accountants use the weighted average, and they're trying to smoothen out the income over the entire year. And that is why they will use the weighted average common shares outstanding, or known as WACSO. That's the first reason. Now, you can be devil's advocate and say, well, what if I didn't issue any new options? What if I didn't issue any new shares and I didn't buy back any shares? In other words, January 1st, December 31st, same number of shares, nothing happened. Then you might say, well, in that case, the both numerator and denominator of shares outstanding would be exactly the same. That's true as well, but here's where we'll add another component. As long as you have dilutive options that you've issued to the management team and other employees of the firm, you are still going to have a slight difference between the ratios. Why will you still have a slight difference? Because when they calculate diluted shares outstanding via the treasury method, which you can go to our exhibit on treasury method of adjusting for dilutive options to calculate diluted shares outstanding for a full explanation of the numbers behind that and how to actually do it numerically, when you actually look at it there, you will see that, again, the accountants will calculate the current stock price based on the weighted average stock price throughout the entire year or the option life. However, or in that time period. However, again, for current diluted shares outstanding that you calculate for current market value, you will use the latest available stock price as opposed to the weighted average stock price throughout the entire time period. And for those reasons, those two major reasons, equity value over net income does not equal price over earnings. So the analysis and the synthesis says as follows. You will only use equity value over net income as a proxy. In other words, you will only use equity value over net income. This is simply a proxy for PE. This is a proxy for the PE ratio. Meaning, when should you use the PE ratio? Whenever you have a stock price and earnings per share. When should you use equity value over net income? For either a publicly or for a privately held company or for a subsidiary of a public or a private company. Because there is no stock price to speak of for that particular entity, there is no earnings per share. So just keep that in mind, that the equity value over net income is going to be a proxy for the PE ratio, not exactly PE. So keep that in mind. In this last exhibit here, we have a financial statement review, and as a quick refresher, all you have to do is, out of this slide, is to make sure that you are able to spit out and reiterate this very quickly. Because in order to successfully navigate the financial statements as well as to build your financial model and valuation, you must make sure that you understand this entire exhibit and how every single number on each of the financial statements are interrelated to each other. For a better explanation and for a more detailed explanation of these interactions between the financial statements, you can feel free to go to our accounting and financial statements module for more information on that. Now, let's take a quick break, and when we come back, we'll actually apply all of the valuation methodologies we talked about, trading comps, deal comps, DCF, breakup analysis. We'll apply that to the actual case study of the $6 billion plus merger between UDS and Valero when we come back. Thank you very much.